Hello and welcome to Navigating Estate Planning with Caress Law. I am Tammi Caress, founder of Caress Law, and today I decided to talk about cost basis and how it affects your taxes. I know this is not a glamorous topic, but it is a topic that will affect everybody at one point or another. And I think it's good to learn this. I actually talk about this in almost every meeting that I have with a new client because it is so important. And now it's time for the disclaimer. The information contained in this podcast and associated material is intended to furnish listeners and users with general information on matters that they may find to be of interest. The information in this podcast provided by Caress Law and its agents are for general guidance and is not intended to replace or serve as a substitute for any advisory, tax, estate planning, or other professional or legal advice, consultation, or service. Sometimes we may reference third-party materials or websites. Such links or references are only for the convenience of the listener, user, or browser. Caress Law and its agents do not recommend or endorse the content of third-party information or sites. You should consult with appropriate Caress Law professionals or other professional advisors for advice concerning specific tax, estate planning, or other matters before making any decision. In summary, this podcast is not legal advice. If you need legal advice or before acting or making any decision with anything talked about in the podcast, seek the counsel of an attorney. Thanks so much. So what is cost basis? Pretty simple. It's what you pay for something. It is your purchase price of a home. It's purchase price of a stock. It's purchase price of a vehicle. So it's what you buy something for. That is your cost basis. And it's important to keep track of this cost basis for particular assets. And I would say a home and stocks. Those are the biggest ones to really want to know what your cost basis is. It also is important for business interests. What you purchased for that interest in a business versus if you were to sell it, what would you sell it for? So your purchase price would be your cost basis. Now, when it comes to a home, for example, also included in your cost basis are capital improvements. For example, if you do an upgrade on your home, you add a new wing, a new bathroom, or something like that, those are called capital improvements. And so you want to keep your receipts and things like that for those type of improvements and let your CPA know, give the information to your CPA. A lot of times it's your CPA who is keeping track of this for you when it comes to real estate. Okay, so why is cost basis important? It is because that is your baseline to determine what is subject to tax if that particular asset is ever sold. So an easy example, I think, is you purchase stock. You purchase that stock for $10 a share. Your cost basis is $10. Now that a stock appreciates in value to $50 a share, and then you decide to go ahead and sell the stock. Well, if your cost basis is $10 and you sold that stock for $50, you will have a realized gain of $40. $40 is what is considered taxable. That is what's taxable. It's the appreciation. So appreciation is taxed. And that's why we need to keep track of cost basis, because you don't want to pay more taxes than you need to, right? Same thing with the home. You purchase the home for $500,000 and you sell it for $800,000. The gain in that home is $300,000 that is potentially subject to tax. And I say potentially because there are, each person has $250,000 of gain when it comes to their personal residence that they can avoid being taxed on if they've lived in their personal residence for a certain period of time. So, but you get the idea. It is basically the appreciation. Okay. So at death, there's this thing called step up in cost basis. When you die, the assets are valued on the date of death, and the new value of that asset becomes the cost basis to your beneficiaries who are inheriting that asset. So I'm going to use your home, and I'm going to call it a second home. So you have a second home. It's worth let's say it's worth $1 million, but you purchased it a long time ago for $60,000. So if you sold that home during your lifetime, your cost basis at $60,000, with a sales price of $1 million, you're paying quite a big chunk of change in taxes because it appreciated so much over your lifetime. And I do see this actually quite often. People have homes in their family that are have appreciated in value due to location and the real estate market. When you pass away, what happens if you own that asset and you didn't sell it? It is appraised, and the appraised value will become the new cost basis for your beneficiaries. That's pretty amazing if you think about it. If you have a historical or family home that you've had in your family for generations, and you've had it for, 80 plus years, and now it's going on to your loved ones, and their new basis becomes the value on your date of death, well, that's a big tax benefit, because if your beneficiaries sell the property, they're going to have very little capital gain. So capital gain is basically the appreciation value, and that's what gets taxed. So the new cost basis in that $1 million home at death is $1 million. So your beneficiaries get a new cost basis. So that's a really big benefit. That is one reason. In my prior episode, I talked about Oregon estate taxes, and we have to appraise property based on the value of your estate on the date of death. And it is required for filing that estate tax return, but it's also the reason we also want to do it is so that we can get that step up in cost basis. So a lot of people say, well, I have this other home or I have these other assets. I'm just going to gift it during my lifetime. That way it gets out of my estate, reduces my overall estate tax burden, and they get a new cost basis. Wrong. The cost basis does not step up by gift. So a gift is when you give something to somebody during your lifetime. For legal speak, a gift is during lifetime. It's not at death. So if you want to gift something during your lifetime, you don't get that step up in cost basis. It's called carryover basis, and the person who is receiving that gift takes your current basis in the property. So using the example of the home that was purchased for $60,000 and is now can be sold for $1 million, if you want to gift that property during your lifetime, we call it the donee. So the donee, the person who is receiving that gift, their basis in the property is $60,000. So I have this conversation a lot in terms of gifting and timing of gifts and whether it's relevant. And we basically, if we are doing gifting during lifetime, we are looking at assets that have a cost basis as close to the current value of that asset because it does not get stepped up. It's also important to note the step up is only on the death of a person, and it's only on the assets they own. So if you own an asset with another person, say a spouse, and that, let's say it's a home, you and your spouse own an undivided 50% interest, you pass away, only 50% of that house, the value will receive a step up in cost basis. So even though you're married, the whole asset doesn't get stepped up if that asset is shared with your spouse, only the portion that you own. Now, it is different for community property states. Oregon is not a community property state, but Washington is a community property state. And we help many clients in Washington and Oregon. And if it is a community property asset, then the step up is 100%. So if two spouses own a property in Washington and it's a community asset, the step up in cost basis is 100% of that asset's value. Unfortunately, because Oregon, we're not community property here, we don't get that step up of the entire asset, just the interest of the deceased spouse's asset. There are planning opportunities available if you are moving from a community property jurisdiction into a non-community property jurisdiction, such as Oregon. And I have clients, we practice both in Oregon and Washington, and I have clients that move across the border fairly often. So there are things that can be done to preserve that community property asset, even if you're moving to a non-community property state. But it is important to talk to an attorney before you buy assets or move assets, because we want to take some action before that happens. But there are planning opportunities available. So highly encourage you to talk to your attorney or talk to us if you're considering making a move. All right. So a few takeaways here, just to summarize. Cost basis is the value of the asset when you purchase it. Step up in cost basis is the value of the asset on the date of death. And that step up in cost basis goes to your heirs and beneficiaries, and their new cost basis is equal to the stepped up amount. If you're gifting during your lifetime, there is no step up in cost basis. The donee who receives that gift receives a carryover basis, which is if you're making the gift, it's your cost basis. So there's not a huge benefit from a cost basis perspective from gifting during lifetime. If you want to learn more about cost basis and how it affects your plan and things that you might be able to put in place, or a plan you might be able to put in place to minimize your overall tax burden, and it could be income taxes and estate taxes and gift taxes. There's lots of different kinds of taxes. Feel free to reach out. I'll also put some information in the show notes below. The website also has lots of resources. It is www.caresslaw.estate, and that is CARESSLAW.ESTATE. I also have my other podcasts on that website. Look for our next content. And if you have any questions, or if you have any ideas that you want to, or topics that you want to learn more about, please feel free to reach out to us. Thank you, and I hope you have a wonderful day.